In the heart of Washington, D.C., within the marble halls of the Eccles Building, a silence hangs heavy over the boardroom. It is the quiet before a seismic shift. For decades, the global economy has operated on a singular, intoxicating fuel: cheap debt. But the engine is sputtering. The Federal Reserve, the architect of the modern financial system, now finds itself trapped in a cage of its own making. The choice before them is binary and brutal. On one hand, they can pivot, lowering interest rates to rescue a faltering stock market and a fragile banking sector, risking a resurgence of inflation that could destroy the purchasing power of the dollar for a generation. On the other hand, they can choose pain, keeping rates high to crush inflation, deliberately inducing a recession that wipes out businesses, jobs, and household wealth. This is not merely a policy adjustment, it is a regime change. The era of zero interest rate policy is dead, and the transition to a new reality is proving violent. As we look at the charts, the inverted yield curve, the drying liquidity in the repo market, and the skyrocketing cost of capital, the warning lights are flashing red. The world is watching because when the Fed sneezes, the global economy catches a cold. We are standing on the precipice of a decision that will define the economic trajectory of the next decade. The question is no longer if the crash will happen, but who will be sacrificed to stop it. To understand the gravity of this moment, we must look at the mechanism of the trap. For nearly 15 years, money was effectively free. The Federal Reserve kept interest rates near zero, flooding the system with liquidity. This created an environment where risk was rewarded and prudence was punished. Asset prices, stocks, real estate, crypto, soared not because of fundamental value, but because there was nowhere else for the cash to go. Then came the inflation shock of 2022. The consumer price index hit a 40-year high, forcing the Fed to slam on the brakes. They raised rates at the fastest pace in history, moving from near zero to over 5% in roughly a year. This aggressive tightening is like draining the oil from a running engine. The first sign of seizing is always in the most interest rate sensitive sectors. We are seeing cracks in the foundation that sustained the post-2008 recovery. The cost of servicing the U.S. national debt has now exceeded the defense budget. This is not just a budgetary issue. It is a mathematical inevitability. When the government itself struggles to pay the interest on its credit card, the entire financial architecture begins to tremble. The most visible fracture is appearing in the real estate sector, a cornerstone of American wealth. For years, the housing market defied gravity, fueled by mortgage rates that hovered around 3%. Today, with rates more than doubling, the math has fundamentally broken for the average American family. Demand has evaporated, yet prices remain stickily high due to a lack of inventory, a standoff that cannot last forever. But the true danger lurks in commercial real estate. Across major U.S. cities, office towers stand half empty, a legacy of the shift to remote work. These buildings were financed with cheap debt that is coming due. Trillions of dollars in commercial loans must be refinanced in the next 24 months, but at rates 2 or 3 times higher than before. Building owners are handing back the keys. This is a slow-motion car crash for the regional banks that hold these loans. Unlike 2008, where the risk was hidden in complex derivatives, the risk today is sitting in plain sight. It is a solvency crisis, driven by the simple fact that the assets on the books are worth less than the liabilities owed. This brings us to the unrealized losses problem, a technical term with catastrophic real-world implications. When interest rates rise, the value of existing bonds falls. Banks, pension funds, and insurance companies hold trillions in U.S. treasuries, traditionally considered the safest asset in the world. However, The aggressive rate hikes have slashed the market value of these bonds. On paper, U.S. banks are sitting on hundreds of billions of dollars in unrealized losses. As long as they don't have to sell the bonds, they can pretend the losses don't exist. But if depositors get scared, if a bank run occurs, banks are forced to sell these devalued assets to raise cash, crystallizing the losses and driving them into insolvency. We saw a preview of this with the regional bank failures earlier in the cycle. The Federal Reserve responded by patching the hole with emergency liquidity, essentially printing money to cover the gap. This contradictory policy, raising rates to fight inflation while printing money to save banks, exposes the fragility of the system. They are stepping on the gas and the brakes at the same time. The structural integrity of the financial system is being tested. The ripple effects of the Fed's policy extend far beyond American borders, weaponizing the U.S. dollar against the global economy. As U.S. interest rates rise, the dollar strengthens, acting as a vacuum cleaner, sucking capital out of emerging markets. Investors abandon riskier currencies for the guaranteed yield of the dollar. This leaves developing nations in a stranglehold. Their dollar-denominated debts become more expensive to service, while their local currencies crash, importing massive inflation. We need only look at history to see how this movie ends. In the 1997 Asian financial crisis, a rising dollar and capital flight decimated the tiger economies. Today, we see similar stress fractures in countries like Egypt, Pakistan, and Turkey. But even major economies are not immune. The Bank of Japan has been fighting a losing battle to defend the yen without raising rates, creating a dangerous disparity. If the Bank of Japan capitulates and raises rates, it could trigger a massive repatriation of Japanese capital, selling off U.S. treasuries and spiking American interest rates even higher. The global financial system is interconnected. A break in one link puts the entire chain under tension. Let's examine a specific historical parallel that haunts central bankers, the ghost of the 1970s. During that decade, the Federal Reserve made a critical error. Under Chairman Arthur Burns, the Fed raised rates to fight inflation, but pivoted too soon when the economy softened. They cut rates to support employment, believing the beast was slain. They were wrong. Inflation roared back, higher and more entrenched than before, leading to a decade of stagflation, stagnant growth coupled with high prices. It wasn't until Paul Volcker arrived and raised rates to nearly 20% that inflation was finally broken, at the cost of 2 severe recessions. The current Fed chair, Jerome Powell, frequently cites Volcker, signaling a fear of repeating the stop-and-go policy era. This historical trauma suggests the Fed will likely keep rates higher for longer, even as the economy screams for relief. They would rather cause a recession now than risk a decade of runaway inflation. This mindset is crucial for understanding why a pivot may not be coming as quickly as Wall Street hopes. However, the economy of the 2020s is vastly different from the 1970s in one terrifying way. Debt. In 1980, the U.S. national debt was roughly 30% of GDP. Today, it is over 120%. This creates a feedback loop that Volcker never had to deal with. If the Fed keeps rates high to emulate Volcker, the interest payments on the national debt become unsustainable. We are currently adding $1 trillion to the national debt every 100 days. This is the debt spiral. As interest costs rise, the government must issue more debt just to pay the interest on previous debt, which in turn drives rates higher. It is a mathematical trap. This is the core of the dilemma. The Fed can fight inflation, or it can suppress interest costs to keep the government solvent, but it cannot do both for long. Eventually, something has to break. Either the currency is sacrificed to inflate away the debt, or the economy is sacrificed to save the currency. The market is currently betting on the former, that when push comes to shove, the Fed will choose to print. We must also consider the role of the credit default swap, CDS market, the canary in the coal mine for corporate defaults. CDS spreads, essentially the cost of insuring against a company going bankrupt, are widening for major retailers and industrial firms. This signals that smart money is preparing for a wave of bankruptcies. The era of the zombie company is ending. These are companies that do not make enough profit to cover their interest payments and have survived solely on cheap debt refinancing. With interest rates now normalizing, these companies face a wall of maturity they cannot climb. We are seeing this in the retail apocalypse, with legacy brands filing for Chapter 11. But the contagion risks spreading to the leveraged loan market, a shadow banking sector worth trillions. These loans, packaged and sold as collateralized loan obligations, CLOs, are held by pensions and mutual funds. If the underlying companies default, the losses will not be contained to Wall Street. They will hit Main Street retirement accounts. The system has built up leverage upon leverage, assuming rates would stay low forever. That assumption has been proven false. This economic tightening is occurring against a backdrop of severe geopolitical fragmentation. For decades, globalization acted as a deflationary force. Cheap labor in China and cheap energy from Russia kept prices low for Western consumers. That era is over. The war in Ukraine, tensions in the Taiwan Strait, and the rise of protectionist trade policies are rewiring global supply chains. Friendshoring and onshoring are the new buzzwords. While strategically necessary for national security, these shifts are inherently inflationary. Building a factory in Ohio is significantly more expensive than building one in Shenzhen. This structural shift means the Fed is fighting inflation with one hand tied behind its back. They are trying to use monetary policy, interest rates, to solve problems caused by supply shocks and geopolitical realignment. Higher interest rates cannot print more oil, they cannot build more houses, and they cannot fix broken supply chains. They can only crush demand. We are entering a period where the tools of the past may no longer work for the problems of the present. To conquer inflation, the Federal Reserve has explicitly stated that the labor market must soften. In plain English, this means unemployment must rise. It is a harsh economic paradox. For the economy to stabilize, individuals must lose their livelihoods. The Fed operates on the logic of the Phillips curve, which suggests that when unemployment is low, wages rise, fueling further inflation. They fear a wage price spiral, where higher pay leads to higher prices, which leads to demands for even higher pay. However, this cycle is playing out unevenly. While the tech and finance sectors, beneficiaries of the cheap money era, are shedding tens of thousands of jobs, the service and healthcare sectors remain desperate for workers. This structural mismatch confuses the data. The headline unemployment rate remains historically low, giving the Fed license to keep tightening. But looking deeper, the quality of jobs is deteriorating. Full-time positions are being replaced by part-time and gig work. The resilience of the labor market is the final dam holding back a recession, and the Fed is actively chipping away at it. The resilience of the American consumer is the other pillar supporting the economy, but it is crumbling. Consumption makes up nearly 70% of U.S. GDP. For the past 2 years, spending was sustained by a massive stockpile of excess savings accumulated during the pandemic stimulus era. That buffer is now effectively gone. To maintain their standard of living in the face of inflation, Americans have turned to plastic. Credit card debt has smashed through the $1 trillion mark, hitting an all-time high. while interest rates on that debt have surged to punishing levels. Delinquency rates on auto loans and credit cards are ticking up, particularly among younger borrowers. We are seeing the rise of buy now, pay later. Services for basic necessities like groceries. This is not a sign of economic health. It is a sign of desperation. When the consumer finally hits the wall, when the credit lines are maxed out, spending will contract violently, pulling the rug out from under corporate earnings and accelerating the downturn. Complicating the Fed's battle is a phenomenon known as fiscal dominance. While the central bank is stepping on the brakes by raising rates, the federal government is slamming on the gas with deficit spending. The U.S. is running budget deficits comparable to wartime levels, despite being technically at peace. The CHIPS Act, the Inflation Reduction Act, and ongoing military aid packages pump hundreds of billions into the economy, creating demand that the Fed is trying to destroy. This tug-of-war creates market dysfunction. The Treasury Department must issue massive amounts of debt to fund this spending, flooding a market that is already saturated. Who buys this debt? Historically, it was the Fed, through quantitative easing, and foreign nations like China. But the Fed is now selling bonds, quantitative tightening, and foreign demand is waning. This supply-demand imbalance puts upward pressure on yields, keeping borrowing costs high even if the Fed wants to pause. The fiscal house is fighting the monetary house, and the currency is caught in the middle. We must also address the plumbing of the financial system, specifically the Treasury market liquidity. This is the bedrock of the global financial system. If you cannot easily buy or sell U.S. government bonds, the system seizes up. Worrying signs have emerged. The bid-ask spread, the difference between the buying and selling price of treasuries, has widened, indicating thin trading. Furthermore, hedge funds have built up massive short positions in the treasury market, using extreme leverage in a strategy known as the basis trade. They are picking up pennies in front of a steamroller. If a sudden shock occurs and these funds are forced to unwind their positions, we could see a repeat of the March 2020 liquidity crisis, where the treasury market effectively froze. In that scenario, the Fed would have no choice but to intervene as the buyer of last resort, pivoting instantly from fighting inflation to saving the system. Financial stability always trumps price stability in a crisis. The danger of a sovereign debt crisis in a developed nation is not theoretical. We saw a preview in late 2022 in the United Kingdom. When the government announced an unfunded tax cut plan, the bond market revolted. Yields spiked and the British pound collapsed. The move almost imploded the UK pension system, which was highly leveraged to bond yields. The Bank of England was forced to intervene with emergency bond buying to stop a financial meltdown, undermining their own fight against inflation. This Liz Truss moment sent a chill down the spines of policymakers in Washington. It proved that the bond vigilantes are back. The market will discipline governments that spend recklessly when inflation is high. The United States has the advantage of issuing the world's reserve currency, granting it more leeway than the UK, but that privilege is not infinite. If the bond market decides the US fiscal path is unsustainable, yields will rise regardless of what the Fed chair says. This brings us to the geopolitical consequence of the weaponized dollar, de-dollarization. It is a slow, grinding process, but the trend line is undeniable. Nations around the world, particularly in the Global South and the BRICS alliance, Brazil, Russia, India, China, South Africa, are actively seeking alternatives to the US dollar for trade settlement. They watched the US freeze Russian central bank assets and realized that holding dollars entails political risk. Central banks are buying gold at a record pace, diversifying their reserves away from U.S. treasuries. While the dollar's dominance won't vanish overnight, a reduction in global demand for dollars weakens the U.S.'s ability to export its inflation to the rest of the world. If fewer countries want dollars, the value of the dollar falls and the cost of imports for Americans rises. This creates a structural inflationary headwind that the Fed cannot fix with interest rates. It marks the end of the exorbitant privilege the U.S. has enjoyed since Bretton Woods. What does this mean for the average individual? The era of passive investing may be ending. The 60-40 portfolio, 60% stocks, 40% bonds, suffered one of its worst years in history in 2022 because stocks and bonds fell together. In a high-inflation, high-interest rate environment, the old rules of diversification fail. We are entering a stock picker's market, or perhaps a market where real assets, commodities, land, gold, outperform financial assets. The wealth gap is likely to widen further, evolving into a K-shaped recession. Those with fixed-rate debt and hard assets will survive, perhaps even thrive. Those who rent, rely on wages that trail inflation, and carry floating-rate debt will be crushed. The middle class is being squeezed from both sides. The cost of living is rising, while the cost of borrowing to maintain that life is skyrocketing. The social contract is fraying as the economic reality sets in. The standard of living for the next generation may be lower than the last. As we approach the endgame of this cycle, the Fed's dilemma intensifies. The market is currently pricing in a soft landing, the miraculous scenario where inflation falls to 2% without a recession. History suggests this is a fantasy. Every major tightening cycle in history has ended in a recession or a financial crisis. The lag effects of monetary policy are long and variable. The rate hikes of 12 months ago are only hitting the economy now. The full impact of 5% rates hasn't even been felt yet. The pivot that Wall Street is praying for will likely only come when something breaks: a major bank failure, a seized credit market, or a sharp spike in unemployment. By the time the Fed pivots, the damage will have already been done. They will not be cutting rates to celebrate a victory. They will be cutting rates to conduct triage on a bleeding economy. The question is not if the pain is coming, but how much pain society is willing to endure before the printing press turns back on. So, how does one navigate this minefield? The first rule of survival in a high-interest rate environment is the elimination of variable rate debt. If you are holding credit card balances or variable rate loans, you are effectively shorting the Fed. You are betting that rates will come down before the interest eats you alive. That is a losing bet. Cash flow is king. In a recession, liquidity is the only thing that matters. The cash is trash mentality of the last decade is dangerous today. While inflation erodes cash over the long term, in the short term, during a liquidity crisis, cash buys you options and prevents forced selling of assets at rock-bottom prices. We are moving from an era of return on capital to an era of return of capital. Preserving what you have is more important than chasing speculative gains. The defensive playbook requires reducing leverage and building a buffer that can withstand an economic shock of 6 to 12 months. Regarding asset allocation, the smart money is diversifying into hard assets. In a world where central banks may eventually be forced to devalue currency to manage debt loads, assets that cannot be printed by a government retain value. Gold has historically performed this role, acting as a hedge against monetary debasement. We are also seeing a bifurcated real estate market. While commercial office space is toxic, residential real estate in areas with strong demographics and job growth remains resilient. though not immune to price corrections. The key is the time horizon. If you are buying for the next 2 years, the risk is high. If you are buying for the next 10, the entry point matters less. However, the days of easy flips are over. Real estate is returning to its traditional role as a store of value and an income generator, not a get-rich-quick vehicle. Beyond financial capital, the most critical hedge is human capital. In a labor market being reshaped by both recessionary pressures and the dawn of artificial intelligence, job security is a myth. The only security is adaptability. We are seeing a white-collar recession where middle management roles are being eliminated. The survivors will be those who generate direct revenue or solve complex, non-automatable problems. Upskilling is no longer a corporate buzzword. It is a survival strategy. During the stagflation of the 1970s, entire industries withered, while others, like technology and energy, were born. Opportunities exist, but they will not be found in the bloated sectors of the previous cycle. The ability to pivot one's career is just as important as the Federal Reserve's ability to pivot policy. We must also consider the psychological toll. Economic crises are rarely just numbers on a screen. They manifest as social unrest and political volatility. As the wealth gap widens and the cost of living bites, populist sentiment rises. We are seeing this globally, from strikes in Europe to political polarization in the U.S. History teaches us that periods of economic hardship often lead to demands for radical government intervention, price controls, wealth taxes, or protectionist barriers. These measures often exacerbate the underlying economic problems, leading to further inefficiency. Preparing for this means understanding that the rules of the game, tax laws, property rights, and regulations, can change rapidly when a government is under pressure. Regulatory risk is now a personal risk. Let's zoom out to the fourth turning perspective. Historians Neil Howe and William Strauss described a cyclical theory of history where every 80 years, roughly the length of a human life, society passes through a crisis that fundamentally reshapes institutions. The American Revolution, the Civil War, the Great Depression, and World War II. We are due. The current unraveling of the financial order, the geopolitical tension, and the internal social division fit the pattern of a fourth turning crisis. This is not doomsaying. It is pattern recognition. These periods are destructive, but they are also regenerative. They clear out the dead wood of the old system, the zombie companies, the unsustainable debts, the decadent institutions, to make way for a new growth cycle. We are in the winter season of this cycle. To reach the spring, we must endure the cold. The Federal Reserve knows this. Jerome Powell knows that his legacy will be defined by this window. If he cuts rates too soon, he becomes Arthur Burns, the man who let inflation destroy the dollar. If he holds too long, he risks a deflationary depression that rivals the 1930s. There is no perfect path. The soft landing is a narrative constructed to keep the public calm while the plane loses altitude. The reality is that the excess of the last 15 years, the trillions of dollars printed, the reckless speculation, the debt accumulation, must be paid for. The bill has arrived. The only variable left is how we pay it, through the fire of high inflation or the ice of a deflationary crash. Ultimately, the system will survive, but it will look different. We are likely moving toward a period of financial repression, where interest rates are kept slightly below the rate of inflation for a long time to slowly erode the real value of the national debt. This transfers wealth from savers to debtors, primarily the government. It is a slow, silent tax on anyone holding currency. The dollar will likely remain the global reserve currency for the foreseeable future, simply because there is no viable alternative ready to replace it today, but its purchasing power will continue to diminish. The lesson is clear. Do not trust the currency to store your labor. Trust tangible value, trust productive capacity, and trust community. The Federal Reserve's dilemma is, in the end, our dilemma. We have lived through a historical anomaly of easy money, and now we are returning to the mean. The transition will be turbulent. The pivot will come, but it will not be the salvation the market expects. It will be the signal that the recession has truly begun. Do not be paralyzed by fear. Panic is expensive. Preparation is profitable. Watch the liquidity, watch the bond market, and most importantly, watch your own balance sheet. The storm is upon us, but for those who are prepared, a crisis is simply a transfer of opportunity. The era of the everything bubble is over. Welcome to the era of consequences.